Investors hear about first-day pops, sometimes huge, and assume going public is a guaranteed win. But the reality is more complex. IPOs often pop early, and many then decline or underperform over time. To understand why, we need to look at how IPOs are priced, market psychology, and the broader economic context. A big reason IPOs pop on the first day of trading is hype. Before listing, there's usually a roadshow, media coverage, and heavy marketing. Retail and institutional investors often build expectations that drive oversubscription, where demand far exceeds the shares offered. Sentiment and excitement can push stocks higher early, even if underlying financials don't justify it. Studies on investor behavior find that companies with high pre-IPO enthusiasm often show strong first-day gains but weaker long-term performance because the initial pricing is driven more by emotions than fundamentals. Another factor is how IPOs are priced. Companies going public and their underwriters sometimes set prices aggressively to maximize the amount of capital raised. This can leave little room for further upside once the stock lists. When the market recalibrates expectations after the first few days or weeks, selling pressure can push share prices down. Even traditionally hot names that looked strong at listing can struggle if cash flow, profitability, or growth forecasts don't hold up post-IPO. Market conditions also matter. Over the last few years, the broader IPO market has faced headwinds. Global IPO activity slumped in 2025, with overall volumes down nearly 9% in some regions like Europe seeing steep declines, as tariffs, volatility, and economic uncertainty weighed on companies' willingness to go public. In the US, while some new listings did raise money, the number and total value were still below long-term averages. Under these conditions, even well-hyped IPOs may lack follow-through buying after the debut. Structural incentives play a role too. Lock-up periods, where insiders and early investors are restricted from selling for a set time after listing, often expire several months after the IPO. When large blocks of shares suddenly become available, selling pressure often increases, further dampening prices. In addition, when early investors or promoters offload shares early, it can signal a lack of confidence to the broader market, prompting additional selling. A real-world example of this pattern is the 2021 IPO of Robinhood. The stock surged nearly 35% on its first day, fueled by hype and massive media coverage, but within months it fell below its IPO price as trading volumes slowed, user growth normalized, and regulatory pressures emerged. This illustrates perfectly how first-day pops don't always translate into long-term gains. Another reason many IPOs fade after their pop is valuation. In recent years, companies went public at high valuations relative to earnings or revenue, sometimes ahead of profitability. When earnings results come in and fail to match expectations, even modestly, stocks often reprice lower as investors rethink their assumptions. What this means for investors is important. The first-day pop is not a sustainable indicator of value. A pop often reflects demand in psychology, not fundamentals. Long-term performance depends on consistent revenue growth, profitability, competitive dynamics, and macro headwinds like interest rates and market volatility. In summary, IPOs pop because of emotion, hype, oversubscription, and aggressive pricing. They collapse or underperform later due to revaluation, lock-up expirations, real earnings realities, and shifting market conditions. Understanding this pattern helps investors avoid mistaking short-term noise for long-term value. If you found this explanation helpful, follow Real Business Today for daily, clear breakdowns of business, markets, and how money actually moves behind the headlines.